So a lot of people say I rent it out for 1,800 bucks a month, but my mortgage is 1,200, and then I have some utilities, so I only clear like 50 bucks a month, 100 bucks a month. Not so fast. When you took out a loan in the mortgage, you received, whether it went to you directly or went to the closing attorney and it never went into your pocket directly, you still received the benefit of a huge amount of money in the form of that loan. And that was not income to you because it was a loan. Likewise, on the payment side, when you pay back that loan, the principal is not an expense. Okay. The loan coming in, not income, the payment back, not a deduction. What is a deduction is the interest. Depending on your particular loan, where you are in your loan life cycle and all those kinds of things, the interest is going to vary. When you say I've got a mortgage payment of 1,200 bucks, it's okay, but how much of that is interest? And that's the part that's actually deductible. Now, the other thing that's not direct is depreciation. Any real estate property, if you own it, you're going to have depreciation, even if, whether you have a condo, whether you have a mobile home, whether you have a 10,000 square foot apartment building. Depreciation is a write-off of the wear and tear of the property. And depending on the numbers, then that can be significant or it might be minor. So we've had people come to us and says, oh yeah, I bought this house that I'm renting out and I got it super, super cheap. I bought it for 30 grand and I put 20 grand into it and I'm renting it for $1,200. I'm like, fantastic. You have next to no depreciation, which from a tax perspective is not as great. On the flip side, you might have a very high price property, which has enormous depreciation, and that's going to kick what you had in terms of cash flow. It's going to kick it into negative for tax purposes because of that depreciation. So most rental real estate that we see operates at a negative for tax purposes because of the depreciation. Now, when it comes to depreciation, there are strategies to apply, right? And again, I don't want to spend 30 minutes on the whole thing, but the basic rules are that for residential real estate, 27 years is the timeline. So you bought something for $270,000, you get 10 grand a year write off. For commercial property, it's 39 years. You can accelerate that by doing what's called cost segregation. And that's separating the property into different components like cabinetry and wiring and landscaping and all these other things. And those other things have a much shorter lifespan and they have much higher depreciation in the early years. And so you can maximize your depreciation expense through cost segregation. But there are caveats with that as far as who can take that when and how much is going to affect their other things, depending on the rest of the things that are going on in their tax world for that year. Whether it's short term or long term, whether you're materially participating, whether you're a real estate professional, all these kinds of things. How much other income you have, and all these. So these are all different factors that go into how you treat these things involving real estate for tax purposes. But fundamentally, worst case scenario, most rental real estate operates at a tax-free basis, meaning that the cash flow that you get is going to be tax-free. Best case scenario, you create a huge tax write-off against other income. So worst case, it's not going to hurt you. Best case, it's going to help you a lot. Real estate can be really powerful from a tax perspective because of that.
Oh,
That is my answer.
okay. So we have a owning a car question, right?
Owning a car?
Owning a car
Okay.
for a business that's
Yep.
not under the EIN. So does it
Okay.
make sense to transfer my car to the business for tax purposes, or how would that
Usually
work
not.
out?
Usually
Okay.
not. In the cases where the car should be owned by the business is if you are using it exclusively for business purposes. We've got one client, he's a security company owner, and he's got 7 cars that are all wrapped with his graphics, and his employees use that to patrol neighborhoods. For that, car should be owned by the business. It's exclusively used for business purposes. If it's a mixed thing, then it's usually better to own it under your personal name and take reimbursements from the company. And you do that through an accountable plan. And basically, you get reimbursed by the company for the business use that you put on your personal car. And that is way more flexible and gets you in way less trouble. Because if you do it the other way, then you have to back out the personal use amounts. And that can cause issues if you don't do that correctly. Also, your insurance is going to be higher if it's in a business name rather than a personal name, because business policies just cost more because you're doing more activity than a normal person. And if you have like a consulting company that you use your card for some business, some personal, just own it in your personal name, get reimbursements. If you are doing something where the vehicle is part of the business, then yeah, do it in the business side. And the great thing about doing the reimbursement way is that you can actually take much higher advantage of your car expenses than you can if you buy it directly through a business. Because on a business purchase of a vehicle, there are dollar limits of $20,000, let's say, I'm rounding here, of how much deduction you get in any one year. And then through reimbursement, you can step around that kind of limitation, which is nice. Comes in handy sometimes. But yeah, usually buy it in the personal name and then take reimbursements.
Okay, sounds good.